So, this video will walk you through the primary differences between conventional and FHA loans and the benefits with each product. FHA loans are government-backed home loans insured by the Federal Housing Administration, or FHA. These loans are designed to assist borrowers when purchasing primary residences. FHA loans are for primary residence transactions only. They allow for higher debt-to-income ratios and potentially a lower down payment. The max loan-to-value, or LTV, ratios for FHA loans are 96.5% on a purchase, 97.75% on a rate and term, and 80% for a cash out. Conventional loans are loans sold to Fannie Mae or Freddie Mac, and all transaction types are allowable. Typically, a higher credit score and lower debt-to-income ratio are required to get AUS approval for conventional loans in comparison to FHA loans. Conventional loans also provide a lower down payment option than FHA for first-time home buyers through allowing an LTV up to 97%. Let's talk about a few major differences between conventional and FHA loans. FHA requires mortgage insurance to be paid regardless of down payment amount, whereas conventional loans only require mortgage insurance when the LTV is over 80%. On conventional loans, as the borrower pays down their principal and reduces their LTV, their monthly mortgage insurance payments will be removed, which is not the case for FHA loans where the MI does not drop off. When running AUS on conventional and FHA loans, you will find that FHA typically approves borrowers with higher housing ratios and debt-to-income ratios than on conventional loans. FHA has less restrictive waiting periods for foreclosures and bankruptcy, which can be beneficial to a borrower looking to buy a home. For example, for most conventional loans, the waiting period for a foreclosure is 7 years, whereas FHA loans are 3 years. FHA loans tend to have higher closing costs. However, FHA allows the seller to pay more of the borrower's closing costs than conventional loans do, which can make FHA loans cheaper upfront. FHA loans also have an upfront mortgage insurance premium that is rolled into the loan in addition to the regular closing costs. When it comes to a borrower employment history with a gap in employment, FHA has re-entering the workforce requirements if there is a gap greater than 6 months. Conventional does not have this limitation. Conventional loans have less restrictive appraisal requirements and property condition requirements than FHA loans, so you will likely see less required repairs on a conventional appraisal. Every borrower is unique, and it's important to take their unique financial situation and goals into consideration when determining which product to proceed with. Thank you for joining us, and if you have any questions about UWM's product offerings, please reach out to your account executive.